Hello, everyone, and thank you for joining this Ius Laboris webinar on key HR topics for regulated financial institutions. My name is Alessia Perez, and I will be facilitating the session for you today. Today's webinar will be given by a set of panelists from different member firms of Ius Laboris, and today we have lawyers from Belgium, Claes & Engels from France, from Capstan, and from United Kingdom, Louis Silkin. Before we kick off the session, I will clarify a couple of points on the housekeeping side. If you have any question throughout the session, you can use the Q&A tab to send your questions to us, and panelists will answer as many as they can during the Q&A session, the last 10 minutes of this webinar. You can, of course, also reach out to the panelists via email after the webinar. Regarding the slides, those will be available on our website, along with the recording after the webinar. That's all for me. I will now turn over to our moderator, Sylvie, to begin the session. Sylvie, you're welcome to start.
Thank you, Alessia. Yes, welcome to everyone. My name is Sylvie Dumortier. I'm a tax partner at Claes & Engels and head of the Comp and Ben practice of the Belgian firm. And I will be the moderator of today's sessions, which, as you know, focuses on some key HR topics in the financial industry. Why finally the financial industry? Well, many of our clients operate in the financial sector. And over the years, we have noticed that HR in financial institution is not only about recruiting, retaining talent, or designing smart compensation packages. It's more than that. It also means dealing with complex regulatory rules and obligations, so that HR often ends up wearing two hats, HR specialist and regulatory expert. So that's why we wanted to talk about issues in this specific sector. The rules we will discuss today mainly apply to credit institutions, but that said, similar requirements are also extended to other regulated entities such as investment firms or asset management firms. And what they have in common actually is that they must implement a remuneration policy that follows specific rules in order to avoid and limit risk-taking for certain individuals, known as the risk-takers. And we received so many questions on this topic that we wanted to address some of the most frequently asked questions and show how the answers differ between Belgium, France, and the UK, three major financial locations. And as Alessia said, we have a great panel with us today to look at how things work in these three countries. And our speakers are Wendy Saunders from the UK. She's the co-head of the financial services team and partner at Louis Silkin. Wendy specializes in financial services regulation, and she began her career in the enforcement division of the Financial Services Authority before moving into private practice. We also have Fadi Sfer from Capstan Avocat. Fadi is an expert in compensation matters and has in-depth knowledge of financial sector regulation. And last but not least, we have Thomas Douillet from Belgium, senior associate at Claes & Engels, and he specialized in corporate governance issues and in the regulatory aspect of remuneration within regulated firms. So we will start a conversation of about 15 minutes, and after which we will open the floor to your questions. But first, my questions. Let's dive in with this first question. What is finally the concept of identified staff or risk taker? And how is that as I said during our preparation, finally the status of risk taker was initially a kind of career milestone, of career goal, and now it finally turns out to be a kind of career hurdle or career inconvenience.
Thank you very much, Sylvie. Delighted to be here. So individuals may consider being designated a material risk taker to be a badge of seniority and importance, and it may involve overall increased remuneration. However, it comes with many additional regulatory responsibilities and restrictions. In the UK, MRTs are certified persons under the Senior Managers and Certification regime, requiring them to pass fitness and propriety assessments, but it also restricts when and how they can be remunerated. The UK Prudential Regulation Authority and the UK Financial Conduct Authority recently reviewed the remuneration code for banks, building societies and designated investment firms to make the regime more proportionate. This included reducing in scope the criteria for identifying material risk takers. That followed on from the removal of the banker's bonus cap back in 2023. The remuneration codes for other categories of firm are to be reviewed by the UK FCA early next year. So, who are material risk takers? An individual is a material risk taker if their professional activities have a material impact on the firm's risk profile, including all members of the management body and senior management, staff members with managerial responsibility over the firm's control functions or material business units, staff members whose activities are deemed to have a material impact on the firm's risk profile under qualitative and quantitative criteria. The qualitative criteria include staff members who have managerial responsibility for legal affairs, accounting policies and procedures, finance, including taxation and budgeting, performing economic analysis, human resources, information technology and security, the development or implementation of the remuneration policy, managing outsourcing arrangements of a function where a defect or failure in the performance of that function would materially impair the performance and or compliance of the firm, and prevention of money laundering and terrorist financing. It also includes staff members who have managerial responsibility for certain risk functions. Moving to the quantitative criteria, this applies to staff members whose earnings are within the 0.3% of the highest earner in or for the preceding performance year, and who are deemed by an individual who has responsibility for the overall management of the risk controls of the firm, which in many cases will be the person performing the senior management function for chief risk function, to have a material impact on the firm's risk profile. I should note that the quantitative criteria no longer includes a specific remuneration figure. So, however, MRTs whose total annual pay for the relevant performance year is 660,000 or below, and whose variable pay does not represent more than 1/3 of their total annual remuneration for the year, will not be subject to the full range of requirements otherwise applicable to MRTs. That's a big increase in the previous threshold, which was 132,000. Also, MRTs who have only been in the role for 3 months or less will also not be subject to the full range of requirements applicable to MRTs. And just to finish this section, I'd say that individuals in firms that are not subject to the PRA's remuneration part should be included as MRTs if they pose a risk to the CRR consolidation group or directly to a CRR firm. The requirements of the remuneration rules apply to MRTs identified on a solo and or consolidated basis or sub-consolidated basis. So I will hand over. Thank you, Sylvie.
Thomas, do you want to say something about this?
About identification. Thank you, Wendy. Thank you, Sylvie. Well, in Belgium, the criteria for the identification of the material risk takers are very similar to those Wendy just mentioned. So you see there are plenty of functions that are identified, and as Wendy just said, historically being identified as a risk taker was a badge of seniority or something to be proud of, and now it is clear that given the constraints related to that identification, there is clearly less enthusiasm in being identified. In Belgium, the most significant constraint is the ratio, the cap on variable remuneration. The ratio in Belgium is set at 50% of the annual fixed remuneration, which is stricter than the European requirement. CRD has fixed it at 100% with the possibility to increase the cap up to 200% with shareholder approval. In Belgium, the cap is 50%, no exception. This is gold plating of the EU CRD directive. And And of course, the ratio is not the only requirement. Variable remuneration of the MRTs must be deferred over at least 4 years. 50% must be paid in instrument. There is a 1 year blocking period. Severance packages are capped, etc. Just interesting to note or to compare is that the exemption from applying the constraints are quite different to those Wendy said for the UK. You are only authorized to pay upfront, so without deferral, and in cash without instruments, when the variable remuneration is below 50,000 euro, which is much lower than what Wendy said for the UK. So the constraints are big with the ratio at 50%, and the constraints are quickly there because the exemption threshold, the proportionality threshold is quite low. As soon as a variable is higher than 50,000 euro, the whole set of constraints apply. And what is worth sharing on that identification aspect is the growing number of questions we receive from clients asking, can we stop identifying this person? Or do we really need to identify this person? Or even most frequently, did we really need to identify that function? And asking this question at the time you want to pay a bonus or an extra severance in the negotiation of an exit is, of course, too late. Once the identification process is finalized for a given year, it cannot be changed retroactively when determining the bonus. And the identification process must be completed annually, as Wendy said. And this might provide an opportunity to redefine who is identified and who is not. Some categories are very clear. The members of the management committee, the heads of control function, the quantitative criteria, identification based on the package, no discussion. Other categories are more flexible. Just two, and I finish there. Senior management. This refers to the level just below the management committee, but the numbers of individuals under that category can be subject to discussion. Of course, discussion is not about do we want to identify. It is about is he or is she really at risk. But we can discuss the number of the employees belonging to that senior management category or responsibility for a material business unit, an MBU, as we used to say. Once you have determined the MBUs in your institution, you might discuss who has responsibility over them. If the MBU is a subsidiary of a bank, for example, is it the CEO of that subsidiary? Or is it the whole management team of that subsidiary? So you see, there is some leeway, there is a proportionality principle, and that can be discussed, but please, at the right moment and at the annual identification process. And that's it for Belgium.
Fadi, do you want to raise a point for France or?
Yeah, so thank you, Sylvie. Thank you so much. Actually, I'm not going to repeat what my colleague said because the legislation is very similar, which is not surprising because, of course, it all historically derived from the same EU legislation. So in France, MRTs are those whose job may have a significant impact on the risk profile of the institution, and those whose remuneration is higher than a threshold, which is very similar to the threshold for the UK, always in the 0.3% of the highest remuneration of the company. And support functions may also be included as well in the condition that Wendy mentioned. And like in Belgium, in France, the cap on variable remuneration is in line with EU legislation, so 100% and 200% with shareholder approval. And I would completely agree with what my colleague just said. It's becoming a hurdle more than a reward. 2 points that are French specific, and I know we'll dive in more into those points later in the webinar. One is the payments that are made upon termination, the severance, is actually lower for MRTs than the payments that are made for regular employees. This talks about a cap as well, monetary cap on the payments, and the payments are lower because they don't take into consideration variable remuneration for a big portion of them. And also, when you negotiate an exit of an MRT, the exit package may be considered under the EBA guidelines and will often be considered under the EBA guidelines as a variable remuneration. So that will mean that the settlement you're paying, the exit package you're paying, will be subject to the cap and subject to deferral obligation. So that's another point where MRTs are not treated in the same way compared to regular employees, which can be considered a hurdle by them in this context, especially when we're talking about support functions.
Thank you, the three of you. So now that we have a bit clarified who falls under these specific remuneration rules, I would like to talk a little bit about, well, the intense competition the financial sector is facing now to find the right talent, and especially the banking industry is going through major changes today, and in this context it's very important for this industry to keep their best people. And with all the regulatory constraints in finance, well, the retention and the attraction of talents can be more challenging than in other industry. And I would like to hear what maybe Thomas thinks about that, about this war for talent.
Yeah, retention is a big issue, Sylvie, so certainly. And certainly in Belgium, we see an increasing use of retention awards. Banking sector is currently undergoing significant changes. Many Belgian banks are being acquired by foreign groups, particularly French ones in the recent years. And in these times, it is crucial for firms to retain their key talent. And on the contrary to the classical industry, retention bonuses in the financial firms must remain exceptional, must be clearly justified, and on the contrary to a welcome bonus that you can pay to a new joiner only the first year, etc., a retention bonus is considered variable compensation, and it is subject to all the requirements relating to variable compensation, so deferral, payment in instruments, performance adjustments, and again, the ratio between fixed and variable. In Belgium, this ratio is particularly strict. So even if the retention award can be spread over the retention period for the ratio purposes, the EBA guidelines allow for that. The 50% cap is very challenging to manage because it is generally already consumed by the annual bonus, especially for someone who performs well, this being the reason for his retention. And we have observed a growing trend in the questions we receive on this topic, such as how to move away from the qualification as variable or from the qualification of retention bonus. And more specifically, can we use fixed premiums, for example, instead, during a restructuring, during a merger or whatever? Can we temporarily increase someone's remuneration without making it permanent? So you see, there is a retention aspect because of the increase, but also a temporary aspect because it is justified by the temporary increase in workload because of that project or because of that merger, etc. But we do not want to increase the fixed based remuneration because we do not want that this extra becomes increased with the annual indexation, or we do not want it to be pensionable. And with other words, can we pay a function premium or a temporary premium or a role-based allowance and qualify it as fixed? And our answer is it is possible to grant such special premiums alongside the base remuneration on a temporary basis, provided that it meets all the characteristics of fixed compensation. And the first and most important one is that it cannot be conditional. So, for example, you cannot state you will receive this premium only if you remain employed until a certain date or until the merger, or only if the merger occurs in the end, or only if your performance is satisfactory. If any condition applies, the payment becomes variable, and therefore the premium must be unconditional and fixed. And if it is For example, if it is paid quarterly or annually, you must apply a prorated calculation in case of early termination. Otherwise, it becomes conditional and therefore variable. So my answer is yes, in Belgium, retention is difficult, definitely difficult in the financial industry because of the cap for the retention payments. Also because some employees not working in a bank are still identified at a bank level with the requirement of ratio, deferral, etc., because their employer is not a bank but belongs to a group where there is a bank, which may trigger identification at group level. And this creates issues of competitiveness with regards to competitors that are not part of a banking group. Perhaps we will discuss this later. But we are seeing a lot of inventiveness, and there are always solutions if you accept the consequences of them, of course.
Thank you, Thomas. And Wendy, how is life going in the UK in terms of war for talent?
Yes, well, we do obviously have a war for talent, not necessarily with the same constraints. So yeah, there are common themes with what Thomas said, but we don't have the restriction of the cap, so we don't have to be quite so inventive in that particular aspect. On guaranteed variable remuneration, where here we're talking about the sign-on bonus effectively, and I will come on to buyouts in a minute, but a sign-on bonus is different to a buyout. So a sign-on bonus is often made in cases where an individual will lose the opportunity to receive a bonus entitlement for the current performance year by leaving their employer partway through the year. And to persuade them to move, the individual is compensated for the lost opportunity. But there are restrictions around when you can do that. So a firm must not award or pay guaranteed variable pay or provide it as an incentive to any member of staff unless it is exceptional, it occurs in the context of hiring new staff, the firm has a strong and sound capital base, and it is limited to the first year of service. To demonstrate that the guaranteed variable pay is exceptional, the firm must consider whether it is exceptional both on commercial grounds and on prudential grounds. Firms should also consider the number of staff to whom they offer guarantees. It is difficult to demonstrate that a bonus is exceptional where a high number of new hires are awarded a guarantee. For PRA-regulated firms, guaranteed bonuses should not be the norm, rather should be rare and infrequent. And under the Remuneration Code, firms must also ensure that all guaranteed variable pay is subject to deferral and performance adjustment. Retention awards differ from guaranteed variable remuneration, or sign-on bonus, and represent awards which are contingent on an individual remaining in employment with the firm for a period of time. Retention awards shall form part of variable remuneration. So although they're not guaranteed variable pay, they're not allowed to be common practice, they should be rare and infrequent, and a retention bonus may be appropriate, for example, in the case of restructuring, a change in control, finalisation of a specific project, or a winding down. Retention awards are also still subject to the requirements around deferral, payment in instruments, and performance adjustment. And they should expressly not be granted to compensate for the lack of performance-related pay due to either insufficient performance or the firm's financial situation. So what could be done more often? So what is typically seen more often offers to new joiners is buyout awards. Buyout awards differ from guaranteed variable remuneration and represent a practice whereby firms buy out outstanding deferred bonus awards for staff that have been cancelled by their previous employer. The PRA expects firms to structure buyouts so that they vest no faster than the awards they replace. A firm must ensure a buyout aligns with the long-term interests of the firm and include, the same factors about appropriate retention, deferral, performance and clawback arrangements. That's essentially, there are exceptions for small CRR firms and small third country CRR firms that are not subject to that restriction. Yeah, so I think that's all I wanted to say on that. Thank you, Sylvie.
Thank you, Wendy.
I'm handing over to Fadi. Yeah.
Fadi, any particular practices in France to cope with retention and attraction of talent?
Yeah, so actually, I think I'll report similar provisions to what Thomas and Wendy said. So in France, sign-on bonuses are very common. It's market practice. It's been market practice for years. Buyout bonuses are also very common to compensate deferred compensation that is lost. due to a resignation from the previous employer. But as a general rule, guaranteed bonus are only lawful upon recruitment and only for the employee's first year of service. So once the general rule is that once this first year elapsed, then the employer must comply with the stringent A regulations and a guarantee may no longer be provided. So retention bonuses are possible. To be honest, the notion of retention bonus has been really defined and enshrined by case law quite recently. So we're still struggling to understand exactly which rule would apply, would not apply based on case law. That's applicable for all bonuses, not only for MRTs. But to go back to MRTs, you would typically have to comply for a retention bonus out of the first year of service with the general provisions, which means it's contingent upon the financial soundness of the company and they must comply with the same deferral and performance conditions as all the variable components. So, as a general rule, you would have to pay 40% of the variable remuneration must be deferred on at least 4 years, and 50% should be paid with financial instruments. So, as a general rule, even for retention bonuses, you would have to comply with those provisions after the first year of service. So, it's quite similar, I think, to what Thomas and Wendy reported.
Okay. Thank you, Fadi. After having talked about about retention and bonuses, let's now talk about maybe a less happy moment, severance, when people leave the firm. Are there specific rules that apply to identified staff when it comes to severance? And what kind of challenges does that create for HR professional in the regulated industry? Fadi, you had already said a few words about it, but maybe you can extend now.
Gladly, yes. So severance calculations in France for MRTs are subject to provisions that are very specific and misalign with the provisions of the labor code that apply to all other employees. So first of all, we determine the severance that employees are entitled to upon termination, except for gross misconduct, based on what the CBA says. We have CBAs per industry in France, and most, if not all, of the industry-wide CBAs that apply to companies that have MRTs will provide that the severance provided by the CBA is calculated based only on the base salary and not the average salary. While for most other CBAs, it will be based on the average salary, and also for the legal severance, it will also be based on the average salary. So we do both calculations, the legal one and the banking industry CBA severance, and we apply the best of both worlds. Most of the time, the banking CBA, to take this example, severance will still be more favorable because the calculation method is more favorable, but it's only based on base salary. So that of course makes a huge impact. It's applicable to all employees of this sector. Now, turning to what's specific for MRTs, what I just told you that the legal severance is calculated based on the average salary. Well, for MRTs, we have an exception that says that all bonuses that may, not that are, but that may be subject to clawback, should be excluded from the basis of reference of the legal severance package. So that's, of course, a big difference compared to usual provisions. So clawback, we'll discuss it later on, but that's when the employee disregarded the rules laid down by the institution in terms of risk taking because they have a responsibility in a significant loss or in the event of a breach of the obligations of good repute and competence. So that applies to the legal CBA severance, but the legal severance, sorry, but that will also apply to most provisions of the labor code that provide damages, and most importantly, the one that's very important, unfair dismissal damages you get when you are wrongfully terminated. For a regular employee, it's based on the average salary. For an MRT, it's only based on the base salary because, of course, most variable remuneration components will be subject to potential clawback. So I think that echoes your first question, Sylvie. Is it a hurdle to be an MRT? Well, I think it is because for most items and bonuses are not taken into consideration, and that has a huge impact on their payout when they are terminated. So when we negotiate the departure of MRTs, that's often a hurdle, and employee lawyers who take on MRT cases often discover the provisions within the negotiation, during the negotiation. So that makes the negotiation more complex because the employee goes into the negotiation with expectations which are actually higher than what he's actually entitled to. So that's a big difference. And of course, as I briefly mentioned before, all payments made upon termination are, as a general rule, considered by the EBA guidelines as variable remuneration. So they must therefore comply with the provisions regarding the variable remuneration, so the cap and the deferral. So obviously, that's also a big problem we're facing when you want to negotiate the exit of an MRT, because you would have to negotiate a deferral potentially for their package that you're going to pay them on top of what the law tells you you have to pay. Because, of course, there are elements that are excluded from the notion of variable remuneration when they are related to the termination. So obviously, payments are compulsory under French legislation or that are based on a court decision are excluded, so they're not considered variable remuneration for the purpose of the ratio, obviously. And also those that are based on a generic and pre-approved formula or non-competes or the sums for which you can demonstrate that they are appropriate. And then you have to show that to the ACPR, which is a body that oversees the good application of these provisions in France. So it's complicated to negotiate the departure. And we also infer from these provisions that some that are paid under a social plan are not variable remuneration. We think they're not. It could be a debate, to be honest with you, because they are required by law or agreed by a collective bargaining agreement. Also, there's an open question as to whether you'd want to settle in court instead of out of court to say, well, the settlement with the employee has been approved by the court, so it's a court decision, so it's not included within the cap. That's also something you may want to consider when you are negotiating the exit of an MRT. Also, in terms of what we see in practice, we see our clients when they reach a cap and don't want to pay a settlement, a potential settlement under a deferral, we see that they extend the duration of the notice or agree a garden leave with the employee for a long period of time. So the employee is paid without, of course, having to work. That's the purpose of a garden leave. And then that would be considered base remuneration and not variable remuneration. That may be helpful, but that also poses another problem because payments, wages are taxable, while settlements and exit package are most of the time subject to a cap, not taxable. So this has a big impact for the employee. So that's a big question we have when we terminate MRTs, and that's also maybe seen as unfair by the individuals at hand, especially when we're talking about support functions that are not actually within the business. That's what I can report on this particular topic, Sylvie.
Thank you, Freddie. And Wendy, do special rules apply in the UK on severance? I guess so, but
Yes, we do. And I guess I tend to see individuals exiting when there's potentially a question mark over them. So my first point really is that payments on termination of employment should not reward failure or misconduct, but should reflect the performance achieved over time. And that's possibly the most significant limitation that we have in relation to severance payments. So severance pay should not be awarded where either of the following applies. Firstly, a staff member voluntarily resigns to take up a position in a different legal entity, unless the payment is required under law, or where there's an obvious failure which allows the employer to summarily dismiss the staff member. So those are the two hard criteria when you can't provide a severance payment. In addition, where a firm does award severance pay, it must be able to demonstrate the reasons for the settlement, the appropriateness of the amount of the payment, and the criteria used to determine the amount. And when determining the amount of the severance payment, the firm has to consider performance achieved over time and assess, where relevant, the severity of any firm or individual failure. And such payments should also be in line with the firm's remuneration policy. Termination payments are variable pay. However, there's currently no need to take certain termination payments into account for the purposes of the payout process rules, being deferral, payment in non-cash instruments, and performance adjustment. And they include termination payments that are mandatory under national labour law or following a decision of a court, similar to what Fadi was saying. Termination payments that are subject to a contractual non-competition clause and have been paid out in future periods up to the amount of the fixed pay which would have been paid for the non-competition period if the staff was still employed. Termination payments where the firm has demonstrated the reasons and the appropriateness of the amount, where either the firm and the staff member agree on a settlement in the case of employment law dispute to avoid litigation, or in broad terms, the staff members being made redundant. So back to my earlier point, what can be paid on exit becomes most challenging when an individual is exiting in circumstances where they may not have complied with their regulatory obligations or may have potentially misbehaved in a way engaging regulatory rules. Whilst firms are not under a legal duty to investigate individuals, the regulatory guidance and expectation is that firms should investigate potential misconduct. If an individual resigns whilst under investigation on the basis of a firm ceasing or not starting an investigation and receiving an exit payment, that could result in regulatory sanction for the firm, being an investigation and potential enforcement action, and or for the individual, including not getting approval or not being employed for a future regulated role. The exit payment that can be made to an individual in this scenario may be limited to pay in lieu of notice and potentially any other payment to which they are contractually entitled to under their employment contract that does not constitute variable pay. So again, similar to what Fadi was saying earlier. And I'll hand over to Thomas.
Thomas, yeah.
I also agree with Fadi and Wendy's comments. It is very difficult to negotiate exit packages with MRTs and to explain them, especially if they are in support function, that there are rules and constraints. And in Belgium, termination payments are considered as variable remuneration by default as well. And again, in Belgium, it is capped at 50%. In the banks, the exceptions to that principle are similar to those Fadi and Wendy just mentioned. The two main ones are the mandatory severance payment under labor law and the non-compete indemnities. What is complex in Belgium? In Belgium, the National Bank prohibits employment contracts for the members of the management committee. It is considered as a collegial body where there cannot be subordination. Subordination would hinder the free expression of idea, and this rule is debatable, but this is the rule, and now this rule is fixed in the banking law, and for management committee members without employment contracts, because it is legally forbidden, the mandatory labor law does not apply anymore. So that exception doesn't apply. So what we increasingly see is that banks use non-compete arrangements if they want to pay termination amount that exceeds the cap of 50%. The cap on variable remuneration. Recently, the National Bank of Belgium allowed an analogy with labor law for the management committee members. So you can pay the legal indemnity by analogy with an employee upfront and without deferral, without instrument, without it being considered for the ratio. But it only accepts to consider the seniority, and the termination payment is based on the seniority in employment law. It only accepts to consider the seniority during the mandate in the management committee, which is very tricky for employees who only stepped up in a management committee recently, but had a longer seniority in the firm. And another complexity is that there is a specific cap on termination payments made to MRTs. It was not required from the EU, but that is a copy-paste on the cap that exists on termination payments for executives in listed companies. maximum 12-month fixed remuneration or 18-month fixed remuneration with a motivated opinion from the remuneration committee. And why is this complex? Because some employees are entitled to a notice period or to an indemnity in lieu of notice that exceeds that cap. As you know, notice period increase with seniority. And how do we deal with this? You can always pay the legal indemnity to an employee, even if it exceeds the 12-month cap, but nothing more. So this limits room for negotiation on exit packages, where we sometimes need to offer something extra in order to get waivers and to secure a termination with a settlement agreement or with a termination agreement. But we cannot pay more. So we must discuss on alternative arrangements, such as retaining a company car or agreeing on internal and external communication, etc. Or again, agreeing on non-compete arrangements. But it can be difficult to enter into such arrangement in case of dismissal, and the employee just wants to find another job after having been dismissed. This is certainly not easy in Belgium also. That's what I wanted to say on severance.
Thank you, Thomas. Well, clawback, Fadi has already talked a little bit about that, and it's an important topic because actually we are seeing more and more clawback clauses popping up in long-term incentive plan or retention bonus schemes. And basically, as Fadi said, it covers cases where a company can reclaim back variable pay that has already been paid out. And it comes straight from the financial sector where regulation make it mandatory. But still, it feels a little bit in contradiction with the employee protections we usually see under labor law. So I'd like to hear what you think about how to strike the right balance. Maybe Thomas, you can give your opinion on that.
Yes, it is. It is definitely in contradiction with the labor law principles. Clawback is difficult to implement in practice because it conflicts with the basic principle that remuneration, including variable remuneration, rewards actual and effective performance, and claiming it back afterwards is legally very delicate. When a bank discovers misconduct, a breach of a code of conduct, or a situation of conflict of interest, or I don't know, it must consider applying a risk adjustment. It is not really an option. It must be at least considered. And there are two possible ex post, we say, adjustments. Clawback, which is reclaiming variable remuneration already paid, or malus, which is reducing the next award or the next deferred portion of a bonus previously granted. Applying a malus is way much easier because it affects the next grant or the next payout of a deferred portion of a previously granted bonus. So if the employee disagrees, the employee must initiate a legal procedure. In contrast, with a clawback, the employer must actively recover the money, and the employee will likely invoke plenty of legal arguments, salary protection laws, etc. And you, as an employer, you must be consistent. If you apply a clawback and the employee refuses to pay the money back, you cannot simply give up. You will need to initiate legal proceedings, which is never pleasant, or to offset the amount against a future payment. But this is really not easy. Offsetting against remuneration is subject to strict limits and generally requires a court decision. So to be honest, I have never seen a successful clawback case because it's extremely challenging, not impossible, but very difficult. There is also the statute of limitation, which is very short in employment matters. And enforceability cannot be guaranteed, particularly before the labor courts, which will be keen to say, but he has worked for that money or for that bonus. So it has vested and you cannot claim it back. At the management committee level, members, as I just said, must be self-employed. So the disputes will fall under the jurisdictions of the business codes, not of a labor code. And I think in such cases, a bank would likely have a better chance. But anyway, good luck. And I don't know how it works in France or in the UK, but in Belgium, I would not bet on success.
Actually, I would agree for France. Like in Belgium, it's very difficult to claw back a bonus in France. But clawbacks are just forbidden in France as a general rule. It's only allowed for MRTs in very limited circumstances. And to give you an example, so I've told you the circumstances before. So one of them is if the MRT failed to abide by the duty of good repute and competence. So we have a 2024 court decision on a sexual harassment claim. So, a top executive in an investment bank committed sexual harassment, was deprived of his variable remuneration, and the bank considered that he failed to meet the standard in terms of good repute. It's hardly questionable that sexual harassment is not exactly within the definition of good repute and competence. The case went up to the highest court, and the court had to rule on both the harassment claim, whether the dismissal was fair, and on the bank's decision to deprive the employee of the bonus and the deferred bonus. And the court ruled first on the bonus piece. So, regardless of the sexual harassment, was a dismissal issue. And they ruled that while sexual harassment can obviously justify the termination of the employment contract if demonstrated, this does not mean that it amounts to a violation of the obligation of good repute. And actually, the court found that this obligation must be understood only in the context of the professional obligations related to the role. So the financial duties of this top executive. So it means that you can sexually harass a colleague in France, but still keep your bonus. So that means that shows how difficult it is to obtain clawback in France, and that is because the clawback is seen as an exception, a very narrow exception to the general provisions of French law. And so, because it's an exception, it must be interpreted very strictly. And I think this court decision is a good example of why in France, just like in Belgium, it's very difficult to obtain the clawback of a bonus. Maybe Wendy, you wanna go to the UK piece.
Yes, so I'm going to have to reserve my comments on sexual harassment. I think the UK regulators have particularly strong views around non-financial misconduct, including sexual harassment. So we'll put that to one side just for now. But in terms of clawback more generally, obviously I agree with what you have both said before, so I don't really want to cover old ground. So I can move on to say sort of documentation, with the challenges of enforcement, you're definitely going to need to have documented it correctly. So you need to put provisions for that in relevant staff documentation, whether that's an employment contract or an MRT side letter, for example. And then if you haven't papered it correctly, a firm could find themselves in a difficult position of choosing between complying with regulatory requirements and breaching employment law. And speaking as a regulatory lawyer, obviously I'd always advise firms to comply with regulatory requirements. So there are requirements that firms' remuneration policies and employment contracts should clarify. Firstly, variable remuneration awards are conditional, discretionary, and contingent upon a sustainable and risk-adjusted performance in excess of that required to fulfill the employee's job description as part of the term of the employment. Such awards may therefore be subject to forfeiture or reduction at the employer's discretion. Variable remuneration, including a deferred portion, is paid or vests only if it's sustainable according to the financial situation of the firm as a whole and justified on the basis of the performance of the firm, the business unit, and the individual concerned. And variable remuneration should be reduced or clawed back, so malus or clawback, according to specific criteria set by the firm, which should, as a minimum, cover situations where an individual participated in or was responsible for conduct which resulted in a significant loss to the firm or failed to meet appropriate standards of fitness and propriety. And that's the kicker. I come back here, just a very high level. Fitness and propriety in the UK has three elements: honesty, integrity, and reputation, competence and capability, and financial soundness. And where sexual harassment will sound in the UK, particularly in relation to honesty, integrity and reputation. So could potentially well, could potentially impact remuneration. But like the others have said, clawback is pretty hard to enforce in practice, so would more likely have other consequences for malice, for example.
Thank you, Wendy.
Yeah.
Well, because we are running a bit short on time and we want also this conversation to be a discussion or conversation with you, we will skip our last question, which was more of a wrap-up into an international environment, but we can come back on this if we answer your question in our 10 minutes time in the Q&A live session. So I don't know, Alessia, if you have any question from or attendees that we
Yes.
could ask?
Thank you very much. So a question for Wendy. The regulatory requirements, expectation that firms should investigate potential misconduct is interesting. What do you define as a misconduct? Is this only risk related, for example, taking over a risky position for a client, failing to report a personal transaction? Or can it be broader, like harassment? And perhaps another question, will you be in position to apply malus clawback to an MRT who committed harassment? Or again, does it have to be risk related only?
Well, thank you very much for that question, Alessia. So just stepping back a bit, I think, I've obviously touched a little bit on fitness and propriety and factors that the UK regulators think are important to take into account. So sexual harassment is definitely a factor that needs to be taken into account. Maybe I can just wind back one step on investigations and the duty to investigate, because what knowledge does a firm have? What knowledge does a firm need to acquire in order to make an assessment about whether something really occurred, and then what actual steps they need to take to deal with that? And so whilst there's not a legal duty to investigate, the regulators expect firms to investigate, and they give 4 reasons why you should investigate. That's to assess the actual and potential damage resulting from the misconduct, identifying other individuals potentially culpable or accountable for the breach, satisfying itself about whether the senior manager, if the MRT is a senior manager responsible for the areas where the misconduct occurred, took reasonable steps to prevent or stop it, and lastly, specifically, if the employee in question here, we're talking about MRT, so yes, is subject to malice or clawback, whether any adjustments should be justified. So all those factors need to be taken into account. The assessments are going to be very fact specific about what is the extent of the investigation that a firm should undertake, and then how is that then going to translate following an outcome into the individual remuneration impact. So there are quite careful balancing acts to be undertaken, balancing carefully, obviously, the regulatory obligations, the employment law obligations, to come to the best outcome for a firm. But it is certainly possible that interpersonal behaviour by an individual could impact their fitness and propriety, and therefore sound in an impact to remuneration, whether that be malice or clawback, both of which could potentially apply. Does that answer the question?
Thank you very much, Wendy. We encourage also the attendees to keep submitting questions in the meantime. We have a question now for Belgium, for Thomas. Under Belgian law and regulatory requirements for MRTs, is it permissible to pay the legally entitled severance amount, and in addition, an extra amount as an incentive for signing a settlement agreement, provided that the total severance does not exceed 1 year of fixed remuneration?
Well, yes, good question. The answer is twofold. First, it is always permissible to pay the legally entitled severance amount. Of course, I would say. If the threshold of 12-month fixed remuneration or 18 months, if you have a motivated opinion from the remuneration committee, is not already reached, you can pay an extra amount. But that extra amount will not be capped at 1 year fixed remuneration, because that extra amount, anything which comes extra compared to the legally entitled severance amount, will be considered variable. So because of the specific 50% cap in Belgium, actually the maximum amount that you can pay extra, if you have some leeway because your threshold of 12 or 18 months has not been already reached, will be maximum 6 months, because you will have 6 months considered variable compensation, and it will be capped at 6 months extra, unless you work with a non-competition agreement, because non-competition indemnities will not be considered variable remuneration. But again, it will count for the threshold of 12 months. So it is possible to pay something extra, but certainly not to pay up to 1 year extra if it is not linked to a non-competition agreement.
Thank you,
Because of the
Tom.
ratio again. I hope it answers the question.
Thank you. Very clear. We have another question for Belgium. In Belgium, do you believe that firms can rely on the exemption of EBA guidelines, pre-defined formula for severance payment, or would you say only mandatory payments by law are valid given how banking law is phrased?
No, that's a very good question, because indeed in the EBA guidelines, the termination payment that are determined in advance in a generic formula in the remuneration policy will be considered as possible and not will not be treated as variable. However, the law and in how is it how it is transposed in the banking law is very strict, and we cannot found back that exception in the Belgian banking law. And on the contrary, we do have that the only exception of the mandatory termination payment and the non-competition indemnities. So if there is a predefined formula which would end up with a payment of more than 12 months or of more than 18 months fixed remuneration, I don't think that you can rely on that predefined formula to have the payment considered fixed and considered not variable. So I'm afraid in Belgium it is more strict. I hope
Thank you very
it
much.
answers the question.
Thank you very much, Thomas.
But indeed, it's mentioned in the EBA guidelines, so perhaps that's something you can justify towards the NBB. But it's not fully sure if there is already a legally entitled severance amount that already exceeds the threshold of 12 months.
We just conclude with a question for France, for you, Fadi. You mentioned employees are highly mobile and could choose to be based in a more favorable jurisdiction in terms of remuneration guidelines. Are there any anti-avoidance provisions in this regard?
Yes, so that's a very good question. The thing is, I'm not sure we do, except for the deferral obligations that are related to the MRT regulations. We do have an impatriate tax regime that actually a lot of MRTs use because they are highly mobile, as you said, Alessia. So, given that they are mobile, they come to France and they have a more favorable tax regime. I think this regime exists in other jurisdictions as well, but there's no rule that says you have to stay for a certain period of time to benefit from the tax regime. So if you decide to leave, then you can, and then you would potentially lose your deferred payments if you are resigning. But other than that, I'm afraid we don't have any provisions that preclude mobility. And I think that this is against the philosophy of French employment law as a whole, which does not want to preclude employees from resigning if they want to. So that would be difficult to implement, although not impossible.
Thank you very much, Fadi. Unfortunately, we didn't have time to take all of your questions, but for any further question, you will find here in these last slides all the details of our panelists, and you can reach out to them via email. We have a variety of resources and insights on tax benefit and other employment law topics on our website, so don't forget to check it out. For more information about our webinars, you can visit the webinar sections to find all the past recordings and download the slide decks. While you are there, you can take a listen to our podcast, Talking Work, in which we talk about the world of work. Finally, I would like to thank everyone for attending, and thank you to our panelists for their very interesting insights today. With that, the webinar will now be ending. Thank you and have a great rest of the day.
Thank you.
Thank you. Thank you.
Thank you
Bye-bye.
all. Bye bye.